In the early 2000s, the world was rocked by a financial scandal that would become one of the most infamous in corporate history, the collapse of Enron. Once hailed as a shining example of American innovation and business acumen, Enron was a Houston-based energy company that had, for years, dazzled investors, employees, and the public with its meteoric rise and seemingly unstoppable growth. The company was founded in 1985, and over the next decade and a half, it transformed itself from a regional pipeline operator into a global powerhouse, trading not just in energy, but in everything from broadband to weather derivatives. Its charismatic leaders, including CEO Jeffrey Skilling and Chairman Kenneth Lay, were celebrated in the media and courted by politicians. Enron's stock price soared, and its executives were lauded as visionaries who had unlocked the secrets of the new economy. But beneath the surface, all was not as it seemed. The company's financial statements, which appeared to show ever-increasing profits and robust growth, were in fact a carefully constructed illusion. Enron had developed a complex web of off-balance sheet entities, special purpose vehicles, and accounting tricks designed to hide its mounting debts and inflate its earnings. These maneuvers were not just the work of a few rogue employees. They were part of a culture that prized short-term gains and aggressive risk-taking above all else. Executives pressured employees to meet unrealistic targets, and those who questioned the company's practices were often sidelined or silenced. The warning signs were there for those who looked closely. Some analysts and journalists began to question how Enron could sustain such high profits in a competitive and volatile industry. Whistleblowers within the company, most notably Vice President Sharon Watkins, raised concerns about the accounting practices and the potential for disaster if the truth ever came out. Yet for a long time, the company's reputation and the complexity of its financial arrangements kept the skeptics at bay. Investors, eager for high returns, continued to pour money into Enron stock, and employees invested their retirement savings in the company's shares, confident that the good times would last. All of this changed in late 2001 when a series of revelations began to unravel the carefully maintained facade. Journalists from the Wall Street Journal and other outlets started to dig into Enron's financial statements, uncovering inconsistencies and unexplained transactions. The company was forced to admit that it had overstated its earnings by hundreds of millions of dollars, and that it was carrying far more debt than it had previously disclosed. As the truth emerged, Enron's stock price plummeted, wiping out billions of dollars in shareholder value almost overnight. Employees who had invested their life savings in Enron shares saw their retirement dreams evaporate. The company, once valued at over $60 billion, filed for bankruptcy in December 2001, marking the largest corporate bankruptcy in US history at the time. The fallout from the Enron scandal was swift and far-reaching. Thousands of employees lost their jobs, and many lost their life savings. Investors, both large and small, were left reeling from the losses. The scandal also exposed serious flaws in the regulatory and accounting systems that were supposed to protect the public from corporate fraud. Enron's auditor, Arthur Andersen, one of the world's largest accounting firms, was found to have aided in the cover-up and was ultimately forced out of business. The scandal led to a crisis of confidence in corporate America and prompted lawmakers to pass sweeping reforms, including the Sarbanes-Oxley Act, which imposed stricter regulations on corporate governance and financial reporting. But perhaps the most lasting legacy of the Enron scandal is the cautionary tale it provides about the dangers of unchecked ambition, corporate greed, and the willingness to bend the rules in pursuit of profit. The story of Enron is a reminder that even the most successful companies can fall from grace when ethics are sacrificed for the sake of appearances. It is a story of hubris, deception, and the devastating consequences that can result when trust is betrayed on a massive scale. As we look back on the Enron scandal today, it serves as a powerful lesson for businesses, investors, and regulators alike. It underscores the importance of transparency, accountability, and ethical leadership in building organizations that can stand the test of time. The collapse of Enron was not just a financial disaster. It was a wake-up call that continues to shape the way we think about corporate responsibility and the need for vigilance in the face of temptation. When investors and employees finally discovered the truth that Enron had been hiding massive debts and manipulating financial statements, the shockwaves were felt around the world, forever changing the landscape of corporate America. In the late 1990s, Enron was the darling of Wall Street, a company that seemed to defy gravity. Its stock prices soared to dizzying heights, and the world watched in awe as the company's value skyrocketed. Financial news outlets praised Enron as a model of innovation and success, and investors clamored to get a piece of the action. The company's headquarters, a gleaming tower of glass and steel, became a symbol of the new economy, one where risk-taking and creativity were rewarded with unimaginable wealth. But beneath the surface, all was not as it seemed. The soaring stock prices were just a mask of financial illusion, carefully crafted by executives who understood the power of perception. Enron's financial statements dazzled analysts, but few questioned the numbers. The company's leaders projected confidence and certainty, assuring shareholders that the future was bright. Employees too bought into the dream, investing their savings and their hopes in the company's continued rise. For a time, it seemed as if nothing could go wrong, but behind the scenes, the reality was far more precarious. Enron's financial empire was built on a foundation of deception, complex accounting tricks, off-the-books partnerships, and a relentless drive to meet Wall Street's expectations at any cost. Executives manipulated earnings reports, hiding massive debts and inflating profits to keep the illusion alive. The company's auditors and advisors, blinded by lucrative fees and the promise of continued business, failed to sound the alarm. As the truth began to unravel, the consequences were swift and devastating. The company collapsed suddenly, sending shockwaves through the financial world. Overnight, Enron went from being a symbol of American ingenuity to a cautionary tale of unchecked greed and hubris. The collapse was not just a corporate failure. It was a human tragedy, affecting thousands of employees, investors, and families who had placed their trust in the company. The fallout was immediate and profound. Thousands of families lost their savings, their jobs, and their sense of security. For many, years of hard work and careful planning vanished in an instant. Retirees who had invested their pensions in Enron stock saw their nest eggs evaporate, forced to confront an uncertain future. Young professionals, once proud to work for a company at the forefront of innovation, found themselves unemployed and disillusioned. The ripple effects extended far beyond Houston, touching communities across the country and shaking the public's faith in the financial system. The pain was not just financial, It was emotional, as families struggled to make sense of the betrayal and loss. The collapse of Enron became a stark reminder that the pursuit of profit, when unchecked by ethics and accountability, can have devastating consequences for ordinary people. In the aftermath, Enron's collapse became a symbol of the biggest fraud in modern history. The scandal exposed deep flaws in corporate governance, accounting practices, and regulatory oversight. Congressional hearings and criminal trials followed as the public demanded answers and accountability. Laws were changed and new regulations were put in place to prevent similar disasters in the future. But for those who lived through it, the scars remained. The story of Enron is not just about numbers on a balance sheet. It is a cautionary tale about the dangers of unchecked ambition, the importance of transparency, and the human cost of corporate malfeasance. It serves as a reminder that behind every financial headline are real people whose lives can be forever changed by the decisions made in boardrooms and on trading floors. The illusion of success, when built on deception, can only last so long before reality comes crashing in. The Enron scandal impacted not only the economy, but also trust between companies and investors and financial oversight laws worldwide. Today, the Enron lesson remains a powerful and enduring warning, a cautionary tale that echoes through the corridors of business, finance, and government. The collapse of Enron was not just the downfall of a single company. It was a seismic event that shook the very foundations of trust in corporate America. At its core, the Enron scandal was about unchecked greed, the manipulation of financial statements, and the catastrophic consequences that can arise when transparency and accountability are cast aside in pursuit of profit. The story of Enron is a stark reminder that even the most respected and seemingly invincible corporations can fall prey to ethical lapses and reckless ambition. Executives at Enron, once hailed as visionaries, orchestrated a complex web of deceit, hiding massive debts and inflating profits through accounting tricks and off-the-books entities. Their actions were not just violations of the law. They were betrayals of the trust placed in them by employees, investors, and the public. As we reflect on the lessons learned from Enron, it becomes clear that transparency is not just a regulatory requirement. It is the bedrock of a healthy and functioning marketplace. When companies operate in the shadows, concealing their true financial health, they put at risk not only their own futures, but also the livelihoods of thousands of employees and the savings of countless investors. The Enron scandal exposed the dangers of a culture that prioritized short-term gains over long-term stability and personal enrichment over ethical responsibility. Accountability too is essential. The Enron debacle led to the loss of billions of dollars, the destruction of retirement savings, and the erosion of public confidence in the financial system. In its aftermath, new laws and regulations were enacted, such as the Sarbanes-Oxley Act, to strengthen oversight and ensure that corporate leaders are held responsible for their actions. These reforms were designed to restore faith in the system, but they also serve as a constant reminder that vigilance is required to prevent history from repeating itself. The Enron lesson is not just for executives and regulators. It is for everyone who participates in the economy. Investors must remain skeptical and informed, demanding clear and honest reporting from the companies they support. Employees should feel empowered to speak up when they see wrongdoing, knowing that their voices matter. And leaders at every level must remember that integrity is the most valuable asset any organization can possess. Ultimately, the legacy of Enron is a call to action, a reminder that ethical leadership, transparency, and accountability are not optional but essential for the long-term health of business and society. The world of business and finance is built on trust, and once that trust is broken, the consequences can be devastating. Let the Enron story serve as a lasting lesson that the pursuit of profit must never come at the expense of honesty, responsibility, and the greater good.